How do I calculate the ROI for oil and gas projects? Are you curious about how to figure out the return on investment for oil and gas projects? Knowing this can help you make smarter investment choices. Let's break it down step by step. Return on investment, or ROI, is a way to measure how profitable an investment is. In the oil and gas sector, it compares the net profit generated from a project to the total amount invested. The basic formula for calculating ROI is straightforward. ROI equals net profit divided by total investment, multiplied by 100. Now, what do we mean by net profit? This is the revenue from the project minus all costs associated with it. These costs include capital expenditures, operating expenses, taxes, royalties, and any other relevant costs. Total investment refers to both the initial and ongoing capital put into the project. When calculating net profit for oil and gas projects, you need to consider several specific costs. First, there are exploration and drilling costs, which can be quite high. Then, you have production and operational expenses, as well as transportation and processing fees. Don't forget about regulatory and environmental compliance costs, which can also add up. Lastly, market price fluctuations of oil and gas can significantly impact your calculations. Because oil and gas projects often take years to develop and come with uncertainties, you might want to use more advanced methods alongside the basic ROI formula. One method is reservoir simulation models, which predict how much oil or gas can be produced by analyzing geological characteristics. This helps estimate future cash flows, which are critical for ROI calculations. Another useful tool is economic modeling software. This specialized software integrates reservoir data with financial models to assess project economics comprehensively. It considers capital and operating costs, taxes, and royalties. You might also encounter Monte Carlo simulations. This approach estimates a range of possible ROI outcomes by accounting for uncertainties like oil price volatility and production variability. This way, you get a more rounded view rather than just one fixed number. Real options analysis is another method worth mentioning. It values the flexibility in decision-making, such as whether to delay or expand projects based on changing market conditions. This is especially useful in the exploration phase, where uncertainty is high. In capitalist economies, calculating ROI for oil and gas projects is essential for investors. It helps them allocate capital efficiently and maximize returns. Investors use these calculations to compare projects and assess risks versus rewards. This informed decision-making drives economic growth. Given the volatility of commodity prices and regulatory environments, incorporating advanced modeling and scenario analysis aligns with capitalist principles. It allows for better risk management and strategic planning. To summarize, calculating ROI for oil and gas projects involves determining all costs and revenues associated with the project. Use the formula ROI equals net profit divided by total investment, multiplied by 100 for a basic measure. Employ advanced modeling techniques to account for production forecasts and market uncertainties. Analyzing ROI results can guide investment decisions in a competitive capitalist market.